Everyone's celebrating Bitcoin's rise, watching those green candles like it's a guaranteed path to wealth, but nobody's actually running the numbers on what happens when you lock up most of the supply and pretend there's still a market. I spent the last week pulling on-chain data, cross-referencing ETF holdings, checking exchange reserves, and what I found genuinely shocked me. This isn't some bear case or foodie campaign. This is math. Cold, brutal math that suggests Bitcoin might be walking into a liquidity crisis that makes the XRP centralization concerns look quaint by comparison. Let me be clear from the start. I'm not a certified financial analyst. I don't have a PhD in economics. I'm just someone who got tired of hearing the same talking points, repeated endlessly without anyone actually checking if they make sense anymore. So I did the work myself, and what I discovered about Bitcoin's actual available supply versus what people think exists is disturbing enough that I need to share it, even if it pisses off the entire crypto community. The problem starts with a simple question nobody seems to want to answer honestly. How much Bitcoin is actually available to trade? Not how much exists in total. Everyone knows that number. 21 million maximum supply, currently around 19.6 million mined. But how much can you actually buy right now if you wanted to? How much moves? How much is genuinely part of the liquid market that determines price discovery? The standard answer you'll get is something vague about exchange reserves or trading volume, but that completely misses the structural changes that have happened in the last 2 years. The ETF launch in January 2024 fundamentally altered Bitcoin's supply dynamics in ways that most commentators still haven't fully grasped. We're not talking about a few percentage points difference. We're talking about a complete transformation of what Bitcoin even is as a tradable asset. Let's start with the ETFs themselves. As of right now, Bitcoin ETFs collectively hold over 1 million Bitcoin. That's not a guess. That's verifiable on-chain data that you can check yourself. BlackRock's IBIT alone has accumulated more than 500,000 Bitcoin. Fidelity's FBTC holds hundreds of thousands more. Add in Grayscale, despite their outflows, and the other approved ETFs. And you're sitting above 1 million Bitcoin locked in these institutional custody structures. 1 million Bitcoin, that does not move. That cannot be sold except through share redemption mechanisms that virtually never happen at scale. Think about what that means. 1 million Bitcoin represents roughly 5% of the total supply that will ever exist. But it's closer to 10% of circulating supply when you account for lost coins. And here's the critical part. This isn't Bitcoin held by traders who might sell if price moves. This isn't Bitcoin on exchanges ready to provide liquidity. This is Bitcoin locked in a structure specifically designed to prevent redemptions, to keep that Bitcoin permanently off the market while allowing people to trade paper claims on it through the stock market. The ETF holders aren't buying Bitcoin. They're buying ETF shares. And when they sell, they're selling ETF shares. The underlying Bitcoin never moves. It just sits there in cold storage while the shares trade back and forth, creating the illusion of liquidity. This is the exact criticism that Bitcoin maximalists have leveled at XRP for years. That it's centralized, that most of the supply is locked up with insiders, that price discovery happens on a small percentage of the actual supply. But somehow when it's Bitcoin, when it's institutional adoption, we're supposed to celebrate this. Nobody wants to acknowledge that we've recreated the same structural problem we claim to hate. Now let's add the long-term holders. On-chain analytics firms track coins that haven't moved in over 6 months or a year or longer. These are wallets that aren't trading, aren't participating in market cycles, just holding through everything. The numbers here are staggering. Approximately 70% of Bitcoin supply hasn't moved in over a year. 70%. That's 13.7 million Bitcoin sitting completely still. Some of this overlaps with ETF holdings, but most doesn't. These are individual holders, early adopters, institutions that bought years ago and have no intention of selling. Within that 70%, about 30% of total Bitcoin supply hasn't moved in over 5 years. These are either lost coins, forgotten wallets, or holders so convinced of long-term value that no price will make them sell. Another massive chunk of supply completely removed from any meaningful price discovery mechanism. These coins might as well not exist from a market functionality perspective. Then, you have exchange reserves, the amount of Bitcoin sitting on exchanges ready to be traded. This number has been declining steadily for years, which everyone celebrates as a positive sign of people self-custodying and removing coins from potential exchange risk. And sure, that's good for those holders. But from a market structure perspective, it's catastrophic. Exchange reserves are currently around 2.3 million Bitcoin. That's the entire liquid supply available for immediate trading across all exchanges globally. 2.3 million Bitcoin to serve a market that's supposed to be global, decentralized, and accessible. Let me put that in perspective. 2.3 million Bitcoin at current prices is roughly $200 billion. That sounds like a lot until you realize that Apple's market cap is over $3 trillion and their stock has reasonable liquidity. The entire market cap of Bitcoin is over $1.3 trillion, but only 15% of that supply is actually available to trade. Imagine if only 15% of Apple shares could be traded. The stock would be completely dysfunctional. Price discovery would be impossible. Volatility would be insane. That's exactly where Bitcoin is heading. Now, here's where it gets really interesting. Let's say Bitcoin continues on its current trajectory. More ETFs launch. More institutions allocate. More long-term holders accumulate and never sell. What happens when available supply drops from 2.3 million to 1 million, to 500,000, to 100,000 Bitcoin globally available for trading? Because that's the direction we're moving. Every month, more Bitcoin moves into ETF custody. Every month, more coins age into long-term holder status. Every month, exchange reserves decline. At some point, you reach a breaking point where the market is no longer functional, where a single large buy order moves the price 10% because there's no liquidity to absorb it, where a country trying to buy a strategic reserve has to negotiate directly with miners because there's nothing available on the open market, where price becomes completely detached from any rational valuation because the mechanisms that create price discovery have stopped working. The Bitcoin community will tell you this is bullish, that declining supply means price must go up. That's supply and demand, right? Less supply, more demand. Price increases. But that only works if the asset remains tradable. If you remove so much supply from circulation that markets can't function, you don't get steadily increasing prices. You get volatility, manipulation, and eventually a loss of confidence in the asset as a medium of exchange or store of value, because nobody can actually transact in meaningful size. This is exactly what happened to XRP in a different way. Ripple held massive amounts of XRP in escrow, releasing it on a predetermined schedule. The criticism was always that real price discovery was impossible because the circulating supply was artificially constrained. Bitcoin maximalists loved pointing this out. They'd say XRP wasn't really decentralized because most of the supply was controlled by a single entity. But what's happening to Bitcoin now is arguably worse because it's not one entity controlling the locked supply. It's a distributed lockup across millions of holders and a handful of giant ETFs, none of whom are selling. You've created the same outcome through different means. Most supply locked, tiny float, dysfunctional price discovery. And before anyone says this is different because Bitcoin holders choose to hold whereas Ripple controlled XRP centrally, Let me point out that the market outcome is identical. It doesn't matter why supply is locked if the effect is the same. A market can't function without liquidity. You can't have price discovery without meaningful trading of the underlying asset. When 90% of the supply never moves, you're not trading Bitcoin anymore. You're trading a derivative of Bitcoin's perceived scarcity. Let's talk about miners for a minute because they're the only consistent source of new supply entering the market. Miners currently produce about 450 Bitcoin per day after the halving. That's about 164,000 Bitcoin per year. In theory, this should provide constant selling pressure as miners need to cover operational costs. But even this is changing. Many large miners are now holding Bitcoin on their balance sheets instead of selling immediately. Some are even buying additional Bitcoin with debt financing. So even the traditional source of fresh supply is drying up. What happens when ETFs want to buy another million Bitcoin, but there's no supply available? They bid against each other. They bid against nation-states building strategic reserves. They bid against long-term holders who might sell at some price. And the price spirals upward, not because of genuine demand for Bitcoin as a technology or currency, but because of a liquidity crisis. This is how you get prices that make no fundamental sense. This is how you get blow-off tops followed by devastating crashes when someone finally blinks and sells. The counter-argument I always hear is that Bitcoin is divisible. You don't need whole coins. You can trade in Satoshis. 100 million Satoshis per Bitcoin. So even if whole coins become scarce, you can still trade fractions. This is technically true, but practically nonsense. Divisibility doesn't create liquidity. If there's one Bitcoin available for trading and everyone's fighting over fractions of it, you still have a liquidity crisis. You still have dysfunctional markets. You still have price volatility that makes the asset unusable for any practical purpose beyond speculation. And let's be honest about what Bitcoin has become. It's not a currency. Nobody's using it for daily transactions. The Lightning Network was supposed to solve this, but adoption is minimal. Transaction fees spike too high whenever there's any meaningful activity on the base layer. Bitcoin is now exclusively a speculative investment asset. People buy it hoping the price goes up. They hold it hoping to sell to someone else at a higher price later. That's it. That's the entire use case for the vast majority of holders. Which means Bitcoin's value is entirely dependent on maintaining the illusion of liquidity and market functionality. The moment enough people realize that there's no actual liquid market anymore, that price is being determined by a tiny fraction of total supply, confidence collapses. Because what good is an asset you can buy but potentially never sell? What good is a market where your ability to exit depends on finding someone willing to pay your price when there's no meaningful order book depth? I want to be clear about something. I'm not saying Bitcoin goes to zero. I'm not saying it's a scam. I'm saying the supply dynamics have become so distorted that the market is heading toward a structural crisis. This could play out in several ways. Maybe we get a blow-off top where price reaches absurd levels before crashing when someone finally sells meaningful supply. Maybe we get a slow grinding loss of confidence as more people realize the market isn't functional. Maybe somehow this all works out fine and I'm completely wrong about the implications. But the math is what it is. You can't lock up 90% of an asset's supply and expect normal market dynamics to continue. Here's another angle nobody talks about. What happens in a real crisis? What happens if there's a genuine need for liquidity? If institutions need to sell? If leverage gets too high and there's a cascade of liquidations? With current exchange reserves around 2.3 million Bitcoin, you're talking about roughly $200 billion of sell-side liquidity at current prices. That sounds like a lot until you remember that billions of dollars in leveraged Bitcoin positions get liquidated in minutes during volatile moves. We've seen this happen repeatedly. Long positions get wiped out, price cascades downward, and normally this finds support as buyers step in. But what happens when there's no depth on the buy side? Because all the Bitcoin is locked in ETFs and long-term holder wallets. You get flash crashes that don't recover. You get moves that break the entire market structure. The ETF defenders will say this is fine. They'll point to gold ETFs and say, those work fine. Gold's market hasn't collapsed. But gold has thousands of years of history. As a store of value, massive above-ground supply, ongoing mining production, and industrial use cases that create baseline demand. Bitcoin has none of that. Bitcoin has 14 years of history, a fixed supply that's mostly locked up, declining new issuance, and a no use case beyond speculation. The comparison doesn't hold. What's fascinating is how the narrative has shifted to accommodate this reality. 5 years ago, Bitcoin was supposed to be digital cash, a peer-to-peer electronic payment system. That failed. So the story became digital gold, a store of value. Now we're not even pretending it's meant to be spent. Now it's explicitly an asset you hold forever. Don't sell, number go up. HODL. The entire community has organized around never selling, which is a weird thing for a currency to optimize for. Imagine if the dollar community's entire ethos was never spend dollars. What good is the dollar then? But Bitcoin isn't trying to be a currency anymore. It's trying to be a speculative asset with artificially constrained supply. And in that context, what's happening makes perfect sense. Lock up as much supply as possible. Create scarcity. Drive price higher. Get more people to buy in. Get more institutions to allocate. Lock up more supply. Repeat. This works great on the way up. It's catastrophic on any kind of down cycle because there's no liquidity to catch the fall. I keep coming back to the XRP comparison because it's so perfectly analogous. The entire Bitcoin community spent years mocking XRP holders for buying into a centralized token where most supply was controlled by insiders. They'd point out that real price discovery was impossible when circulating supply was a fraction of total supply. They'd argue that any pump was artificial because Ripple could dump tokens whenever they wanted. All of that criticism was valid. But now Bitcoin is in almost the same position. Most supply locked up and not trading. Price determined by a small liquid float. Potential for massive dumps if large holders decide to sell. The only difference is the narrative around why the supply is locked. With XRP, it was centralized control. With Bitcoin, it's decentralized hodling. But the market outcome is the same. And here's the thing about market outcomes. Intent doesn't matter. Whether supply is locked because of centralized control or because millions of individuals chose to never sell doesn't change how the market functions or dysfunctions. You still have the same liquidity crisis. You still have the same price discovery problem. You still have the same risk of catastrophic volatility. The Bitcoin community convinced itself that decentralized supply lockup is somehow different from centralized supply lockup, but from a market structure perspective, it's identical. Think about what happens with leverage in this environment. Bitcoin derivatives markets are enormous. Billions in open interest on perpetual futures. Massive amounts of leverage on both the long and short side. All of this is collateralized by the assumption that there's a functional spot market underneath. But if the spot market has become a liquid, if actual Bitcoin can't be bought or sold in size without massive slippage, then all that leverage is built on sand. When the inevitable deleveraging event happens, when cascading liquidations start, there's no backstop. The spot market can't absorb the selling pressure because there's no depth. Price gaps down 50% in minutes because there's no one on the other side of the trade. We've already seen glimpses of this. Flash crashes on individual exchanges. Massive wick downs that instantly recover. These are warnings. These are the market showing you that liquidity's gone, that the order books are thin, that if real selling starts, there's nothing to stop it. But everyone ignores these warnings because price recovered, so everything's fine. Until the time it doesn't recover, until the wick down doesn't wick back up because there's no one left to buy. I want to address the obvious question. So if I really believe this, why am I making a video about it instead of shorting Bitcoin? Because timing this is impossible. Markets can remain irrational longer than you can remain solvent. Bitcoin could double from here before any of this matters. It could hit 150,000 or 200,000 on the back of continued ETF inflows and nation-state buying. The structural problems I'm describing don't prevent price from going higher. They just guarantee that when it eventually breaks, the break will be catastrophic. This isn't a trading recommendation. I'm not telling anyone to buy or sell. I am pointing out mathematical realities that most people are ignoring. The available supply of Bitcoin is collapsing. Exchange reserves are at multi-year lows. ETFs hold over 1 million coins that never move. Long-term holders sit on 13 million coins that never move. That leaves about 2 million Bitcoin actually participating in price discovery. And that number shrinks every month. At some point, something has to give. Either price goes so high that long-term holders finally sell, breaking their own ethos and flooding supply back into the market. Or price stays high, but liquidity dries up completely, and Bitcoin becomes effectively untradeable. Or we get a crisis that forces selling and the market gaps down catastrophically because there's no bid. None of these outcomes are good for people who think they own a liquid asset they can sell whenever they want. The Bitcoin community will call this FUD. They'll say, I don't understand Bitcoin. They'll say this is all bullish because scarcity drives value. And maybe they're right. Maybe I'm completely wrong about all of this. Maybe removing 90% of an asset's supply from circulation is fine. Maybe markets will figure out some new equilibrium. Maybe everything works out great and we all make money, and Bitcoin becomes the global reserve asset. But the math suggests otherwise. The math suggests we're building toward a liquidity crisis that will make previous crypto crashes look tame. And before anyone accuses me of being a Bitcoin hater, let me be clear. I want Bitcoin to succeed. I want decentralized money to work. I want an alternative to fiat currency that can't be inflated away. But wanting something doesn't make it true. And right now, the data shows that Bitcoin has transformed from a potential currency into a speculative asset with broken market structure. That's not hate. That's observation. The saddest part is that this was all predictable. The moment institutional adoption became the goal, the moment we started celebrating BlackRock buying hundreds of thousands of coins and locking them in ETF custody, we locked in this outcome. You can't have both institutional adoption at scale and a functional decentralized market. Institutions don't work that way. They accumulate and hold. They remove supply from circulation. They create exactly the supply shock we're seeing. And now we're stuck with the consequences. So what's the solution? I don't know. Maybe there isn't one. Maybe this is just how it goes. Maybe Bitcoin becomes a frozen asset that almost nobody can actually trade, held by long-term institutional and individual holders who never sell, with price determined by tiny amounts of marginal trading on exchanges. Maybe that's stable somehow. Maybe price just goes up forever on declining liquidity until it doesn't. Maybe we limp along like this for years before the inevitable crisis. What I do know is that the numbers don't lie. Available Bitcoin supply is collapsing. Exchange reserves are at historic lows. ETFs have locked over 1 million coins. Long-term holders sit on over 13 million coins. The liquid market is a tiny fraction of total supply. And every month this gets worse. More coins move into long-term storage. More ETF accumulation, less availability. At some point this breaks. Maybe not today, maybe not this year. But eventually, markets with no liquidity stop being markets. I reran the supply math because nobody else seemed to be doing it honestly. Everyone's so caught up in price predictions and bullish narratives that they've stopped looking at the actual market structure. And what I found is genuinely concerning. Bitcoin might have become exactly what it was meant to replace: a financial asset controlled by a small group of holders with broken price discovery, where regular people can buy in but might never be able to get out. That sounds a lot like the traditional financial system. It sounds a lot like XRP. And it's definitely worse than anyone wants to admit.